call it, has pegged the Indian GDP growth at 7.4% in real terms, and the nominal GDP has been placed at 8%. The 7.4%, a very good number compared to the 6.5% last year, is coming on the back of very strong services and manufacturing sector estimates. How does this compare with our poll? It is slightly lower than our poll. Our poll threw up a real GDP number of 7.5%. The MOSPI is a little more modest at 7.4. The RBI stands at 7.3, by the way. So clearly, these are more modest numbers. Nominal GDP of in the poll came in at 8.3%, with several people at 8.4 and 8.5. But the MOSPI is way more modest at 8%. Nominal GDP is important. This is the actual output in the country this year without adjusting for changes in prices. That is the overall number, GDP number, which we have to take into consideration when we measure fiscal deficit. The nominal GDP is also important, or the pace at which it grows is important for taxes, important for earnings growth. So the nominal GDP coming in at 8% may be seen as a disappointment, because historically India always had a double-digit nominal GDP growth number. In the first decade of the 2000s, we were running at 14 and 15% nominal GDP numbers. But now with the control of inflation, the nominal GDP for the first time is coming in single digits. Well, even last year was a single-digit number, but 8 is a new low if you don't look at the COVID years. That perhaps is one big takeaway. What are the other big takeaways? We have a panel of experts, expert economists, to speak to us and parse this number. We are joined by Kaushik Das, the chief economist at Deutsche Bank, Madhavi Arora, the chief economist at Emkay Global Services, and Kanika Pasricha, the chief economic advisor at Union Bank of India. Kaushik and ladies, thank you very much for your time. Kaushik, 7.4, is it practically in line with what you thought?
Yeah, I mean, most people were expecting around 7.5. Our own forecast is more modest at 7.2. I didn't want to change it, before CSO's forecast. So 7.4 is broadly in line with what people were thinking. But the nominal GDP obviously is lower than what I thought. Our own forecast is 8.3. So 8 is slightly lower than that. And if you see that nominal GDP has come down from 9.8 of previous year to 8, almost 1.8% decline. Yeah. Whereas real GDP has gone up from 6.5 of previous year, supposed to go up to 7.4. So about 90 basis points increase. So it's again a question of which one you should give more importance to, nominal or real. And the question about whether we are managing to calculate the deflator properly or not. If we had a different deflator, the double deflator debate that we have, whether the real GDP would have been lower, whether it would have been consistent with the core inflation, excluding gold being on the lower side. Earnings growth, obviously muted because of the low nominal GDP, FI outflows we have seen through last year. So yes, depending on whether you want to see the glass half full or half empty, it depends whether you want to look at the nominal or the real. But overall, I think nobody expected GDP growth to be above 7% this year. So on the surface of it, it looks like it's a stronger number compared to what people thought in the beginning of this year.
Oh, absolutely, absolutely. In the beginning of the year, almost everyone's forecast was sub 6.5%. And the Reserve Bank was seen as aggressive when it came with a 6.7% number. But now, yes, 7.5%, especially after the very strong Q1 and Q2. Just to remind our viewers, Q1, we posted a growth of 8% and 7.8% and Q2 at 8.2%. First half, we average 8%. But since the CSO or the MOSPI is saying that the full year is going to be 7.4, by arithmetic, they are assuming that the second half we grow only at 6.8%. That's not a bad number, especially because the base is fairly strong in the second half. Madhavi, first thoughts, is this 8% nominal GDP growth a very big disappointment?
Hi, Latha, not really, because, if I look at the government assumption for FY26 nominal GDP, it was also now, while they had taken a higher number during the budget forecast, if I look at the revised number, they were looking at close to around 8% growth. So I think I'm not very disappointed because we already had built up our expectation the nominal GDP would be close to even sub 8% for that matter. That said, of course, this is way below the 10-year average of 10%, way below the 15-20 years average, wherein we were generally seeing a 14-15% nominal GDP. With that, obviously implies that all macro and market variables, be it fiscal deficit to GDP, sovereign debt to GDP, and credit growth, and even corporate earnings, all of that need to be recalibrated accordingly. So obviously, any slippage on nominal GDP growth, I mean, of course, this is again an advanced number.
Madhavi, I'll just rest your worries on that. In the budget, the assumption was that FY25 nominal GDP would be 324 lakh crore.
Yeah.
On top of that, 10.1% would give us 356 lakh crore. But when the May numbers came, last year's number came in at 330 lakh crore, as you know. And therefore, even at 8%, I calculate, it comes at 357.
Exactly.
The nominal GDP is higher than what the budget estimated, even with a lower growth number. So the worries about fiscal deficit.
At the margin, yes. Yeah, we were not expecting that to be a bigger variable for fiscal per se, any which way. So we were expecting it to be in terms of value terms, largely matching the government's forecast on fixed. So I agree with you. There was not much of a disappointment on that side. And obviously, we had already built up a nominal GDP growth, which would be close to around 7.8 to 8%. So pretty much in line with the view that the market is already sort of playing with.
Fair enough. I'll come back to you on nominal GDP, since we will have to worry about what the budget assumes on February 1st. But before that, Kanika, I wanted all your views on the consumption and the investment numbers. The consumption number is is estimated at only 7% compared to 7.2 last year. What is this telling us? That the GST cut-related bump is not expected to continue? Does this look modest to you, 7% consumption?
So, Latha, first of all, Happy New Year.
Oh, thanks.
And what you said is absolutely right, that initially the kind of numbers we had seen in high-frequency indicators for consumption, be it auto sales across indicators, yes, we were looking at a stronger number for GDP growth even for Q3 because of the consumption-led boost. But this data is showing a slightly different picture. So we had thought that even December quarter number will clock above 7%, but a 6.8% average for H2 is somewhere signaling that consumption boost, I would want to say it will not sustain, but it's not as strong as the lead indicators and the initial thought process came across on account of GST-led booster. That said, the boost was much needed. We need consumption as a growth driver in a world where there's so much uncertainty, and capex growth momentum, in our view, is primarily led by government. Private sector is yet to catch up.
Okay. Madhavi, to come back to you on consumption, isn't MOSPI being very, unambitious or conservative in that 7%? After all, we did see very good auto sales numbers. Even the December numbers were good, year-on-year comparisons. Maybe better when the actual GDP is announced?
The consumption boost that we have seen post GST cut hasn't been broad-based. We've discussed that anyway in the past as well, where it has been very concentrated on sectors like auto. If I look at consumer durables and consumer staples, there hasn't been as much excitement as one would have liked. And beyond the festive season, any which way the fourth quarter would have seen a little bit of fading. To that extent, then the income effect is still very dominating in the urban sector, which has not seen much of an upside. So I wouldn't be surprised if consumption, while might still do better than investment in the next quarter or even next year, I'm not sure whether that would be a big, exciting variable in terms of really driving the growth story in India per se. Because I think while the tax incidences come down, which obviously at the margin boosts consumption, one, it has not been across the board. Two, the wage impact or the income impact would be still more dominating in that context.
Okay. Kaushik, your thoughts on consumption and also investment. Very strong number at 7.8% compared to only around 7% last year.
So investment is easier to understand because, the government capex has been stronger than the year of 2024 when because of elections and all, government could not spend in the first half of the fiscal year. So this year, obviously there was supposed to be a boost, and then second half of the fiscal year that is supposed to fade out a bit, going forward, because the base effect will normalize. So first half was expected that government spending would be higher than on a year-on-year basis. So
yeah, actually, it is higher by 28%. I just calculated,
which is not
surprising. It was because of the low base.
Yeah, because of the low base. So what is important and interesting in this forecast that CSO has given, as you pointed out, that 6.8 for the second half of the year. Then the question is, how much is for October, December? How much is for January, March? We don't know that. But the point is that they're saying that growth will kind of decelerate in the second half as the base effect normalizes. So investment and the private sector obviously is, on hold because of the uncertainty and the broad-based capex recovery that we talk about beginning of each year. That has not taken place. So overall, it's the government push that has helped the investment. And again, we are hoping that this continues in the budget for next year as well. Okay. On the consumption side, we should not forget that in 2024, we were seeing a broad-based, credit growth decline. And RBI had clamped down on, credit, unsecured credit. And, there was this concerted effort to bring credit growth down, which obviously had its impact on 2025. Then beginning of 25, the RBI started reversing all this, tightening measures and started cutting rates, giving liquidity. Now, these things take time to have impact. So despite that, we have managed to grow at 7%. I would say we are doing well. But we have to figure out whether, how much of it is, due to a low deflator, how much is the real, consumption taking place, adjusting for the deflator impact. Are we really growing at 7%, 7.5% kind of, private consumption growth, with private consumption being close to 60% of GDP? Yeah. So my guess is it's not as strong as the headline number that is being reflected. And question is, going forward in FY27, should we see a higher growth or should we see a lower growth than 7%? Particularly as the base effect normalizes, as the deflator, is corrected, as inflation moves up. So I think overall it's a good number, but if you drill down into some of these intricacies or nuances, you might find a fault here and there.
Yeah, I know the consumption number seems a little disappointing considering that so much was done for consumption. The Reserve Bank went all guns blazing on rates and liquidity. As well, you saw the government both cut income tax and GST rates. So therefore, this 7% comes as a bit of a surprise to me. Maybe the estimate will be bettered when the actual numbers come. We don't know. But the positive is the investment. 7.8% is seeming to assume a private capex growth as well. It can't be 7.8 only with government capex. Is private capex also picking up? That question after the break to our economists.
Your money on the line. This is Network 18, and you're watching CNBC TV18.
When the market moves, we don't just report, we decode.
From the boardroom to the trading floor, we track what's driving business and impacting investor sentiment.
With insight that empowers and guidance that builds wealth.
Nuvama presents CNBC TV18 Market Central.
For your daily source of market intelligence and wealth creation, with a commitment to doing it right.
Welcome back. The MOSPI, or the Ministry of Statistics, has announced its advance estimates of this year's GDP, and it is placing the real GDP growth at 7.4% and the nominal GDP growth, that is growth unadjusted for price rise, at 8%. The 8% is a tad lower than what the budget had assumed of 10.1%, but the 7.4% real growth is better than Reserve Bank's forecast of 7.3%. 7.4% is anyway a growth to kill for. The context is that the first half was 8%, and therefore the MOSPI is assuming a 6.8% growth in the second half, that is Q3 and Q4. I've been speaking with economists Kaushik Das of Deutsche Bank, Madhavi Arora of Emkay, and Kanika Pasricha of Union Bank. Ladies and Kaushik, thank you very much for your time. I wanted to get this investment argument right. Kanika, the investment growth is seen at 7.8%, very strong number. Does this assume that there is a good private capex pickup also? This can't be only because of government capex, can it?
So, Latha, completely agree with you, but just that, let's understand that this is basically, in my view, led by a few sectors. Because, for first half of the year, the listed corporates, when they came out with their numbers for capex in their balance sheet reporting, it did not show a very strong momentum, which is broadly in line with the kind of environment we are dealing with. But some sectors are really shining. Like renewables continue to shine, data centers is doing well, even iron, steel, healthcare. So some sectors are showing a very strong momentum, but it's not a broad-based story in our view. That's one. Second, so we think that, while yes, private sector capex has shown some signs of recovery, because we cannot have sustained deleveraging in corporates, we cannot have sustained downward momentum in capex as well. However, government capex continues to remain prime driver of overall capex growth of 7.8, with central government reporting 28-29% till November.
Yeah, if they stick to the entire budget, then they would be doing 10% higher than last year. But government capex is still a very small portion of the overall, gross fixed capital formation number. It's a very, very small percent. Therefore, this 7.8 assumes government capex, assumes private capex. Very quickly, Madhavi, are you seeing it? Or will we, when the final numbers come, be disappointed? It may not be 7.8.
Yeah. So, Latha, as you rightly said, the government is only a small player in the overall capex picture. I think informal sector and household participation has been a major driver of investment growth, specifically in the past 3 years. In the first half of this year, we've seen private capex announcement hitting a decadal high of around 15 trillion plus. But at the same time, we have to see how much of that actually sort of converts into actual investment. In the last cycles of capex that we saw FY24 were led by government as well as the real estate cycle. Now, the government cycle also has largely peaked, while we are going to see probably 8 to 10% growth in government capex in the next 2 or 3 years. As a percent of GDP, I think government capex has largely peaked at around 3.1%. At the same time, the real estate cycle is also near its peak. So incrementally, again, I think it'll be very important that the large cap, as well as the the mid companies and households, they continue to participate in the capital formation cycle, which I think at this point in time is still, as Kanika was mentioning, is extremely selective in sectors like EMS, sector like renewable energy, data centers, semicon, auto and EVs. All of these sectors are, the one which are having a concentrated capex at this point in time. The broader listed universe is likely to adopt it in a more gradual fashion. We also have a lot of uncertainty with regard to what is going to happen to India-US trade deal, which could impact, the low end of manufacturing segment in terms of their investment, which is the SMID universe, or the informal universe as far as the investment is concerned. That will be a very big variable. Plus, given the fact that, we are still looking at an excess capacity in the world order, which is somewhere spilling into, the way the reaction functions of private players is also evolving. All of that also will be very important. So I think I would still be a little wary of assuming that we are in for a big investment cycle. The importance of household and the SMID economy has to be taken into account. And the fact that the private capex guys are still a little more cagey with regard to what is happening in the global order, as well as the trade deals that we are negotiating with the US. So I think as of now, the broader listed universe may not necessarily be following suit of certain segments and selective sectors that I mentioned.
Yeah, fair enough. I think earlier today, Knight Frank released its real estate, investments number or sales number. And while office space has grown 20%, that's a very small part. The residential space has degrown, has fallen by 2% year on year. So overall growth is perhaps about 4% if you count office, that is residential and commercial. It's not looking like a very good number, and real estate is a very big driver of investment. It's not looking very bright, but as you say, it could be data centers. But the bigger number that I'm looking for from y'all is next year's nominal GDP assumption. With just 8% this year, Kaushik, what's the best assumption that the government can reasonably go with for next year?
So I think, Latha, they can take 10%, to start off with, because inflation is supposed to go up for CPI. And also remember, all these numbers that we are discussing will probably become redundant by the time we get the new GDP series or in February end. And you know that they will discontinue the current series and they'll just give the new series. And the new series will be for 3 years full data. So as of now, this particular series would be used for calculating your fiscal ratios in the budget, revised estimates, and next year's estimate. But by the time we, go to the end of February, we'll get a new series of data. And based on that, we'll have to see how the numbers are looking like, whether it changes materially from what has been announced today, then whether the next year's numbers will kind of change according to that. So all the fiscal numbers will go for recalculation in April once you get the new series of GDP. So that apart, what I think is that, 9.5%, 10% is a realistic estimate for next year. As long as, if you're changing the way you're calculating the deflator, then probably, you could get, different numbers for next year. I would say the government probably will assume 10% to start off with for the fiscal calculations. Now, whether it ends up being 9.5%, I don't expect, nominal GDP to be lower than 9.5% next year, because I see inflation picking up. And therefore, we could manage, if we even have 6.5% to 7% growth in the next fiscal year, to assume 3.5%, 4% inflation, I think would be okay. And 9.5%, 10% would be my guess. But I think the government would prefer taking at the higher end of 10% and doing the calculation. Later, we'll adjust depending on how the revised estimates also become actual estimates, and all these nuances will come into play.
Okay. Well, at 10%, the GDP will look like 392 trillion or 393 trillion rupees. So at 4.2%, I think the fiscal deficit will work out to 16.5 trillion, which will be fairly modest, actually. If only 70% of that is government borrowing, it looks like a benign number for the bond market. So that nominal GDP number is very important, what they forecast or assume. Ladies and Kaushik, I don't have much time, so a monosyllabic rapid-fire question. Kaushik has said 10% nominal GDP, Madhavi, assumption for next year.
But I would also take. I think they would work with 10% nominal.
Kanika?
Same camp, 10.
Oh, very good. There's some consensus here. The other is a more speculative question. Will the February 28th recast make the GDP higher or lower? I just want one number, one word. Kaushik?
Higher.
Higher, good. Madhavi?
I also think a tad higher.
Okay.
May not be very different, but a tad higher.
Kanika?
Higher.
Oh, very good. So I think we're going with optimistic assumptions here, and I think reasonable optimistic assumptions. You all are not kite flying over here, which means that the bond market shouldn't be very unhappy tomorrow with a 10% nominal GDP assumption and the likelihood of it actually being higher when the recast numbers come. It looks like a manageable borrowing program will be in the works. But I'm getting ahead of myself. At the moment, the numbers are very much in line with expectation for the current year. Thank you very much, Kaushik, Madhavi and Kanika, for taking us through these numbers. We wrap up on this special broadcast on the state of the economy. Do stay tuned. Lots more lined up for you.